Hello, everyone. I'm Michael Brown, General Partner at Battery Ventures, and it's my pleasure to host this next panel, The Future of Insurance, the Disruptors Perspective, with Daniel Schreiber, co-founder and CEO of Lemonade, and Michelle Cheung, CFO of Next Insurance, two of the best next-generation insurtech platforms, redefining how we think about insurance. I'm going to start with Daniel and Michelle in a minute, but we would love to have audience participation. So if you have any questions during the session, please send those to events@battery.com, and we'll try to pick those up at the end. So I'm going to start, Daniel, with you. This session is called The Disruptors Perspective, which I think is perfect for Lemonade and your approach to the market in so many different ways. One of the interesting decisions that you made early on was where to start. You know, most insurtechs travel the well-trodden path of starting as an agent, graduating to become an MGA, and then take the final big step of becoming a carrier. You turned that completely upside down and launched with a new carrier right at the start. So talk to us about that decision and what have you learned from that journey that others might find helpful?
Sure. Michael, thank you. Good to be with you. Michelle, great to be with you as well. And I have to say, I feel a little bit uneasy with the disruptor moniker. I try not to use it too much. In any event, I think that disruptions cause disruptors rather than the other way around. There's sea changes in the world that give rise to companies such as Next and Lemonade. We don't necessarily cause that upheaval. We take advantage of it. Be that as it may, when Shai, my co-founder, and I were looking at what to do in Lemonade in the early days, the perspective that you gave voice to just now was very, very loud among our board and prospective investors and actual investors as well, which was the MVP orthodoxy, minimally viable product, stick to your knitting, do what you guys know. You've been 20 years in the tech industry, tech entrepreneurs, but you don't know anything at all about insurance. So why don't you partner with somebody who actually understands what they're doing and you do the pretty front end stuff that you guys understand? And we felt pretty strongly, it was one of those decisions that we made early on, and we're so glad in retrospect that we did what we did, which is we felt early on that the kind of change that we wanted to affect can't be done, or at least it would be much, much, much harder to be done if we don't control the entire stack. And sometimes what appears to be the short road is actually the long road. And that while it sounded daunting, it was in fact daunting, establishing an insurance carrier in the great state of New York. I think trying to do what we've done without going that route would have been more daunting still, and I'm not sure it was entirely possible. So we felt that the challenges facing mass adoption by young consumers of digital products wasn't just that they lacked a digital app. That kind of the final bit of the user experience, that veneer, would not be enough to affect the kind of change to create the kind of value that we were looking to create. And if you took a 100-year-old edifice and you stuck a fresh coat of paint in front of it, that wouldn't do. We felt that the business models themselves needed to be changed, that we had to work with the regulators to rethink some of the fundamentals of insurance, how a policy is written, how it's priced, what is the profit structure. Maybe we'll talk a bit later, but how do you neutralize some of the conflicts of interest that plague the insurance industry and that required thinking about giving certain monies to charity and taking flat fees and deep changes in the plumbing. And since that's really what we wanted, we felt that there was no way to achieve what we were looking to achieve without taking all of that on board. We're pretty happy that we went that route. And I'll add one more perspective on that, which is that insurance at its core is about data and pricing and underwriting risks. And if somebody else is making some of those fundamental decisions and owning some of that data, and you're more at the kind of front end, you're tying your own hands. You can give a nice user experience, but when it comes to really dealing with the plumbing, not only of the user experience and aligned business models, but of pricing and underwriting risk and getting really expert at that using the best technologies available, you have to build the whole thing from scratch.
Great. We'll come back to that topic in a minute. I do have to embarrassingly admit, we've known you a long time. And I think one of the primary reasons we turned you down in that first round of financing was we thought you were crazy going down this path. So clearly we were wrong. Congratulations for having the foresight to kind of think and do things differently.
Thank
So
you.
Michelle, I'm going to turn it over to you. So Next Insurance, which we're an investor in, we didn't make the same mistake twice. I'm glad to hear that. You've taken the more traditional approach of becoming a carrier by going through that progression I mentioned before. In hindsight, what lessons have you learned? And if you were advising a de novo insurtech, what's the best approach? Is it the go full stack day one, or is it take the more traditional migratory approach to becoming a carrier over time?
Sure. Thanks, Michael. And also, thanks for having me. It's great to be here with you and Daniel. First, I would say I applaud Daniel's decision to go carrier direct. I think it is crazy, but this is having the experience of doing things sort of out of sequence, I'll call it. But sometimes I think it is the right thing to be crazy. It's always a bad thing. The other thing that I would say is I absolutely agree with Daniel. It is daunting. This is absolutely what we found as well. But all of the rationale that he described in terms of being full stack, having control of the full product and customer experience, and making sure that sort of the full value chain is there to extract value from the technology platform that you're building. We absolutely saw this as well. I would say in terms of advice for a de novo insurtech, I think it really depends in terms of the sequence, what it is that the insurtech is looking to do. For example, our customer segment, the small business owners, it's slightly different when we're going about and building product, because there are so many lines of business that a small business owner may need to have to really find that their whole business is covered. And so what we found was, by going the agency route, and more specifically the managing general agent route with a fronting company and a reinsurer, we were able to scale very quickly. So we were able to have 50 states plus DC very quickly with our product. And we started with general liability product, which is less geographic specific than property is, for example. Like, we don't really worry that much about coastal or wildfire areas, because slip and fall risks are sort of slip and fall risks. And so it allowed us to get scale immediately with our first product, while at the same time, in parallel, building out these internal teams that were designing the next product, the next product, the next product. So our product coverage, our filings for commercial auto, for workers' compensation. Like, this was our vision, to be a one-stop shop, so that we were getting scale immediately with the agency, always with the goal of bringing that all onto the carrier, because our long-term vision is exactly that, which Daniel described. But this really allowed us to move faster in some ways, by virtue of the fact that our customer segmentation that we were after needed all these products, and it allowed us to build them at the same time.
Was capital structure or financing also part of the decision, or not?
It is, but I would say that really, we would look to solve that based on what the customer needs are and what the business needs were. I think we could have solved for the financing. It's somewhat market dependent, but I think we could have solved for the financing based on what we thought the right sequence and the right business model was to go after.
Okay, great. All right, I'm going to move on to another question. I think we all really enjoy the kind of entertaining and humanizing commercials, with whether it's a Gecko or Flo from Progressive sitting on the beach, on her day off, or Limu, Emu, and Doug from Liberty Mutual. But most people view their insurance providers with ambivalence at best, right? The overarching perception of insurance is that it's needed, but it's not liked. It's relied on, but it's not necessarily trusted. Both of you have managed to build very large, fast-growing businesses, serving, as we talked about, two very distinct customer segments. So Daniel, I'm going to start with you again. You've obviously had remarkable success in driving affinity for the Lemonade brand and getting your policyholders engaged with you as their insurer. So what strategies have you found to be effective getting the millennial consumer to trust in and get excited about insurance?
It's a great question. And it preoccupied us a great deal as we were thinking about Lemonade in the early days. Neither I nor my co-founder come from the space. So we came at it with a kind of naive and outsider's perspective, which is helpful when you're trying to rethink how to do things. So we didn't have the knowledge curse because we didn't have any knowledge. So we tried to kind of squeeze our ignorance for all it was worth. And one of the things when you approach insurance with something like a blank slate is you look at exactly what you described, Michael. And we ran the surveys and stuff. You know, most Americans consider insurance to be a necessary evil, not a social good. But you know that from dinner table conversations as well. And we paused to say, why is that? It is when you think about it, we grew up with it. So it's just ambient kind of attitude. But insurance at its core is about a community of people pooling their resources to help their weakest members in their hour of need, which is pretty much the dictionary definition of a social good. How do you go from that to the perception of insurance that we have today, which is 180 degrees apart? And we spent a while thinking about that in the early days and this question of trust. And in the early days, some of our investors didn't want to invest. Apparently, I didn't know this because we were vertically integrated. Others were reticent because they thought that a young insurance company led by people who have never done insurance with a juvenile name and a silly pink logo will never engender trust. And part of the thesis of Lemonade was that trust doesn't work that way, particularly with younger consumers. So how do the State Farm, Allstate, Farmers, all the companies with state and farm in their name, how do they project trust? And I think if you just look out of your window, everybody in their city, you'll see kind of the template, which is you roll into town and you build the tallest skyscraper. So those of you on the West Coast, you've got the Transamerica building that dominates the San Francisco skyline. And in New York, you've got the MetLife building that dominates that skyline. And you may detect the remnants of a London accent. The Swiss Re, also known as the Gherkin building, which is so dominant there, and city by city. And I think the playbook is basically to project that you have tremendous financial strength. I get to build the tallest building in the city, and you put 10,000 people in it, and that is meant to engender trust. And we didn't have that option, so it was a little bit self-serving, but we liked to think that for today's consumer, the concern with insurance is not that they haven't got the wherewithal to pay. It's that they don't have the will to pay. And they don't question whether their insurer can afford it. They question whether they have the motivation, whether their interests are aligned with them, and therefore whether they will pay. And we ran the surveys and found that most Americans don't believe their insurance company will pay them without a struggle when they need it. In fact, one of the things we discovered early on is the Urban Dictionary, the crowdsourced dictionary online. Its definition of insurance, I'm going to read this, is a business that involves selling people promises to pay later that are never fulfilled. That is the crowdsourced definition of insurance. For good measure, I'll read how they apply the usage of the word. Goma paid flood insurance premiums for years, but then the insurer decided to go out of business when the flood came because management had spent all the premiums on hookers and private jets. Not a nice reflection on our industry.
No,
but I think
indeed.
if you want to know the pulse of the people, look it up on Urban Dictionary, you'll get a fair reading.
Yeah.
So for us, it was about going back to the basic building blocks. And I referred to this earlier, which is, could we build an insurance company that was not conflicted, or certainly a lot less conflicted than the traditional model? Insurers don't actually make that much money from the underwriting profit, the money that's left over. But we felt that that money poisons the well, because if you make a claim of me, Michael, and I deny your claim, you're claiming $10,000, and I deny your claim, I'm 10,000 richer and you're 10,000 poorer. And whether or not you have a deep understanding of insurance, you understand that you're in conflict with your insurance company. They make money when denying your claim. And then there's all this asymmetry. There's asymmetry of information because they understand the policy, you don't. There's asymmetry of power because they already have your premiums, you don't. Early on, when one of our founding team members was Professor Dan Ariely, the celebrated behavioral economist who'd written a book about honesty and trust, and reached the conclusion that if you wanted to build an institution with a stated aim of bringing out the worst in humanity, it would look a lot like an insurance company. Everything that is 10 years of interest said you should not do is manifested in spades. So for us, it really went back to not just the tech, it went back to building an unconflicted business model, taking a flat fee, saying that if there's money left over, we're going to give it to charity, not pocket it ourselves. And there's a lot of game theory about signaling and about the basic assumption that this isn't about how good a human being you have at the top of the institution. It's not the players, it's the game. And if the game has incentives that are distorting or that put you in conflict with your customer, you're putting a really low ceiling on how much alignment you can have with them and how much lovability you can create into your brand. And just to finish off, once you've built a business model that has that alignment, then technology can kill it. If I don't have an incentive to deny your claim, why not use AI to pay it in 3 seconds, which is what happens with a third of our claims today, and get sales to happen in a matter of seconds. And that's how you start getting younger consumers engaged. You've got a user experience that is seamless, paperless, instantaneous. You've got a business model that's aligned. You've got some social good in the form of give back of remnant monies. And you end up with a cocktail of value, values, and experience that really, it's a change in degree that amounts to a change in kind by the time you wrap all of that together.
That's great. That was a great answer. Thank you. All right, so Michelle, you've got a very similar challenge, albeit with a small business owner as your customer. I have the benefit of knowing your Net Promoter Score, and it's top decile relative to the rest of the insurance industry. So what is Next Insurance doing so differently to drive such great customer satisfaction?
Yeah, it's interesting. I actually think our challenges are they're analogies to what Daniel described, but because the small business owner, I would say, I guess, suppose we have the benefit of having this tremendous opportunity in the small business market where it's tremendously complicated, the types of insurance that a small business owner needs to buy. It's not just sort of homeowners for their house, and if it burns down or something gets stolen, that's covered, or auto insurance for my car if I get into a car crash, that is covered. They have to understand that, this general liability policy protects me from slips and falls. The professional liability policy protects me if I give somebody bad advice and I get sued. The workers' compensation policy protects me if an employee gets hurt. Like there's so many, it's so complicated. It really is not they're not in the business to understand what their insurance covers and doesn't. And this is really why, this is the value, I would say, that agents are serving in the market today. And that really what is our opportunity, actually, is to make it simple and more tailored to these businesses, so that we make it simple enough, and then B, we also try to educate the small business owner so that they know what needs to be covered for their business, and then we provide that coverage. And I think because of that level of complexity, there's that opportunity for us with technology to step in and provide really a superior product and experience to the customer in that way. And that's really what we think our NPS score is reflecting. People really, from the purchase, I would say there are these magic moments for small businesses. It's both, I would say, at purchase. They're starting a business, they find out they need insurance. They are moving into a new office, and to sign the lease, their landlord requires a certificate of insurance to prove that their belongings are covered. They hire an employee, they need statutorily to be compliant, they need workers' compensation insurance. When there's a claim, that's a classic magic moment as well. And we have the ability with technology that I would say is unmatched against those who sort of have legacy platforms, to be able to be there in that magic moment and hopefully actually even predict and be there before these magic moments happen for our small business customers. And this is really what the approach that we've embraced. And I would say, one of the reasons why we have the NPS score that we have.
And one quick question on that is it all a digital interaction, or do you actually talk to your customers? And how important is that human contact versus digital interaction?
So we do both. And we really believe that we want to meet the customer where they want to interact with us. I would say if they're, really busy and it's 8 p.m. on a Thursday night and they really don't want to talk to somebody and they just want to change their credit card information, like go to a portal, go change it, and you're done. But on the flip side, when there's a claim, somebody has hit, either gotten into an accident. I mean, our very first claim, actually, that we adjudicated in house was a situation where somebody's tools got stolen. It was in an urban area, and there was actually like a shooting that had happened as well. And this person really wanted to talk to somebody on the phone. I don't think this person, they deliberately did not want to go online to their portal while they could do that and provide us with a first notice of loss or file a claim online. They wanted to talk to a person, explain the situation, really feel that there was another human on the other end of the line to sort of go through this experience with them. And again, we want to make sure that any avenue that is the way our customer wants to interact with us is available to them in the easiest way possible. And we think this is really important as well.
So you bring me to the next question, and it's central to one of the themes today, which is embedded finance, right? Sharon in the intro talked about the convergence of software and financial services. Next just bought a company out here in Boston called AP Indigo. Daniel, I know you have Lemonade API as an embedded product offering. Michelle, I want to stick with you since you brought it up. With the AP Indigo acquisition, the ability to actually consume Next Insurance kind of at the point of purchase, if you will, within a software solution, when did that light bulb go off? When was kind of the moment? When did you realize it? And then how did you guys make the decision to go forward with that and ultimately to make the acquisition of AP Indigo?
Yeah, it actually, I would say it had been stewing for a while. There are two main reasons I would say for the acquisition, and then I'll sort of get into to actually answering some of your questions, Michael. But the first was the distribution channel. It's a major distribution channel. It's an established practice that, and just to take a step back, what AP Indigo does, and they have partnerships with online digital payroll providers, essentially. So a small business goes into a platform like Intuit or like Gusto or maybe Toast and says, hey, I want to sign up I'm hiring employees. I want to sign up and provide my employees with a payroll solution. And we talked about magic moments right before this. This is a magic moment for them. They're setting up their business. They're hiring employees. They by a statute, it's a state requirement that they get workers' compensation insurance. This is when they're thinking about it, and really the moment that you want to interact with the customer with a particular experience. This is a purchase experience. And so we saw that it had already been established. And we said, let's tap into this distribution channel and combine what AP Indigo has done fantastically, as I would say, with their partners, and bring a one-stop shop, fully digital solution to those customers. So now when they're thinking about buying workers' compensation insurance because they've signed up employees, did you know that you can get general liability insurance? If you have a car, you can get commercial auto insurance, and so on and so forth. And so you can satisfy all of your insurance needs at that moment in time. The second thing that the acquisition brought us, and again, that we'd been thinking about for a while, is really the data and the integration. And this gets to core underwriting capabilities and being able to think about the risk of the business. And I say the risk of the business, not the general liability risk of the business and not the workers' compensation risk of the business, but we want to think about what is the risk of the carpenter's business overall, and how do I think about that? And if I'm hooked into an online payroll provider or an online accounting system, and you're now making lease payments, is it time to serve up a COI to your landlord? If you're now making auto payments, do you have commercial auto insurance? Like, there are some additional sort of touch points that we can have to benefit, to provide and serve and offer products to the customer. And on the back end, we're now collecting additional data points to the extent that they've had a claim on their auto. It helps us better underwrite their workers' compensation policy potentially, or their general liability. It gives us a richer view of that business that I would say it's rare for other insurance companies to look at small businesses this way, and it's a huge competitive advantage. And this is really what the acquisition and embedded the fact that this is embedded into a different experience for that small business really brings to us.
Are there any kind of, if I'm an insurtech in the audience thinking about this kind of alternative distribution, are there any kind of key do's and don'ts going down this different distribution path?
It gets, again, I think there are some specific things that are particular to the customer segment that we've targeted, and that the small businesses in particular. I'd say what we found, because before we acquired AP Indigo, you can believe we were trying to have conversations with all of their online payroll providers saying, hey, we've got a fully digital solution. You should use us as an alternative or alongside these guys instead. The tightness of the integration with the partner really matters for this segment, I would say. And so this was something that was very attractive to us. They have, there are a number of developers actually on the partner side who really understand the AP Indigo product and offering. And this tight integration really enables both the distribution channel, but also the data. And so this was really key for us.
Great. Daniel, how should the world think about the Lemonade API?
So most of our sales are direct to consumer. We've worked hard on establishing a brand that resonates with consumers and establishing channels. So we do sell directly to consumers by and large, but everything that we do directly, we also offer through an API. So you can imagine a lot of opportunities that you're buying something that isn't insurance. For example, you're getting a mortgage from the bank. It is a requirement that you have home insurance before you can conclude your mortgage. So today what you have to do, even with the digital first mortgage providers, which is its own kind of area of FinTech, you have to stop the process, go out, get in your car, drive to Main Street, speak to your broker, come back and send them the policy. But we can today do all of that through an API, and usually actually it's a much more abbreviated process. As it is, buying insurance on Lemonade is a median time of 90 seconds. I read somewhere that the median time to get a coffee at Starbucks is twice that, 3 minutes. So it's a pretty quick thing. But you do constrict that even further when you're dealing with a website that already has all the information. There's no way you're going to get a mortgage without telling them your name and your date of birth and your address and all that kind of stuff. So actually, we can usually provide a bindable quote with exactly 0 questions to the consumer, and we do that just embedded in the website of whomever it is that you're getting that with. So for example, SoFi embeds and offers Lemonade insurance in exactly that format. So you can see that increasingly we're offering life insurance and pet insurance, and all of these offer opportunities within their existing ecosystems to use API-based offers and one-click purchase opportunities, which is really just a million miles away from what you associate with buying an insurance policy today.
Got it. Michelle talked about a minute ago, the embedded strategy allows them to gather a lot of traditional underwriting data, but a lot of non-traditional underwriting data to help inform and price risk. Are you doing the same thing at Lemonade with either through the API or other ways, or how do you think about the use of traditional and non-traditional data for underwriting and even claims adjudication?
Absolutely. And Michelle and Next live in a slightly different regulatory framework than the one that we do. The consumer space is the most regimented in terms of regulation. So there's some things that she has liberties to do that we don't. I'm very envious, Michelle.
I'm super grateful for it, I was going to say.
Nevertheless, yeah, I think actually it's part of our secret sauce. Honestly, I do. I think 2 or 3 years ago, if you spoke to leaders of incumbent insurance companies, they'd heard of Lemonade, everyone asked them about it, and they'd pay us the backhanded compliment of saying they're good at PR and they've got a nice app. And the implication was these guys don't get insurance. You know, this is kind of a fleeting thing. And I think what they fail to understand is that neat app generates about 100 times more data than a human broker-based interface would. So one of the insights that the insurance industry has learned and that we take full advantage of is that being a responsible human being is a generalized condition. And what I mean by that is, so for example, 20 years ago or so, the insurance industry learned that credit scores are highly predictive of kitchen fires. You say, what on earth is the connection? And the connection is that people who pay their bills on time, also lock their doors, also clean their gutters, and also don't leave candles unattended to on the kitchen table. Being a responsible human being is a generalized condition. So any signal that you can pick up that somebody is a responsible human being is predictive of insurance risks by and large. Now, when you're sitting in front of a human broker and buying home insurance, they'll ask you anywhere between 20 and 40 questions, but you will be emitting many more signals. You know, are you fidgeting or are you paying attention? When the broker is explaining the coverages, are you busy on Facebook or are you listening? Do you ask no questions, dumb questions, or smart questions? And you're just emitting signals all the time, which are entirely lost in the ether and left in the room there because she's busy just answering the questions that she has on the template in front of her. When you do everything digitally, none of that is lost. I'll give you a few hypotheticals because we don't talk about this. It's, as I said, it's a bit of secret sauce, but 2 people come to Lemonade from Google. One searched for good insurance, one searched for cheap insurance. Is that a signal about what kind of risk they represent? One came at 2 a.m., one came at 2 p.m. Is that a signal? One went through the entire process in 60 seconds, one did 5 minutes. One read everything carefully before signing, one not, etc., etc. So all of these things are gathered over time, and then the machine learning does what it does, and it finds the deep correlates. And we find that some of these things are incredibly predictive. There's one button that some people press and some people don't, and the loss ratio is 100% difference between those who do and those who don't. You get some really powerful signals, and then you get others that on aggregate add up to a pretty powerful signal. So the first point that I think is highly differentiated, and actually here in the APIs, we lose some of that. Because if all of that process of onboarding was done by someone else, then actually the richness of the signals that we collect are lesser, albeit oftentimes somebody like a SoFi is its own pre-qualifier kind of, so that is a powerful signal in and of itself. So number one is just the digital experience produces stunning amounts of data that turn out to be highly predictive and cannot be replicated if you aren't built on a digital substrate. The second piece is there's something incredibly difficult about growing a business higgledy-piggledy over decades and through acquisitions and trying to smash together systems as incumbents typically have done. I was speaking to one CEO of a large insurance company, and he was talking about how they spend $3 billion a year on IT. We don't think of IT as anything, you know, we don't talk about IT much, but $3 billion a year, and honestly, he's got nothing to show for it. And he's doing that because he's got this spaghetti code. It's no fault of his own. This is just the reality with which he has to contend. Spaghetti code written in COBOL from the 1980s that they have to try and deal with. And I said to him, I said, you know, we've used a fraction of that to build a black box, and you've got a black hole. It's just something you throw money into. And that brings me to the second thing is not only being built on a digital substrate, but having a single unified system. So at Lemonade, we have this customer cortex where all insights about our customers are combined. And when you click on a marketing campaign, or when you call in or write into our customer support experience, and whether you paid your bills on time, and what claims you've made, and what questions you asked, and every part of the flow is all unified into a single place, so that what your behavior was when you bought a policy can impact what policies we'll recommend to you further down the road, whether you get a claim paid in 3 seconds, or whether we're going to make an appointment to come and see you, et cetera, et cetera, et cetera. And the single unified system is an incredibly powerful thing, incredibly, incredibly powerful, which I just don't think, if you weren't built from scratch in the 21st century, trying to retrofit a business that was around in the era of the horse-drawn carriage with these kinds of things is a very tall order. I don't envy the people who have that mission.
Great. All right, so trying to tie all of this back to the theme of the conference, which is kind of the end game. want you to polish off your crystal ball and talk about it. Michelle, we'll start with you. From your perspective, kind of what inning are we in for InsurTech? And what do you see are some of the big opportunities and problems that the industry still needs to solve? And we've got a little more than 3 minutes before we got to cut over. So,
okay, so I'll try to be brief. I think it's early innings. I think some of the things that we can solve because of the technology and the digital substrate that we have is to be more adaptive and predict what the business needs before it needs it, before it knows it, so that it really is an even more seamless experience to the business than it is today.
Okay, great. All right, Daniel, same question to you.
Sure. I definitely agree with Michelle that it's still early days, and you just have to look at the total market size, $5-point-something trillion business. Our competitors are doing $100 billion a year and have been doing that for 100, 200 years. So this is a prize worth fighting for, but none of us, all the insurtechs combined, we've barely made a dent on this. In my mind's eye, this is somewhat akin to Amazon circa 96, 97. Not that any one of our companies necessarily becomes Amazon, but just that you're dealing with incumbents that are not going to disappear overnight. Now, 20, 30 years later, we still see retail exists. And I don't think incumbents are going to evaporate, not overnight and not in the next 20 years either. But that if you had a chance to invest either in InsurTech or in incumbents, it's going to be very clear and ever more clear with the passage of time where the better, smarter investment is. Because, and this comes back to that backhanded compliment and the nice app and all of that, as with Lemonade, in my mind's eye, somebody at Walmart back in 95 said, oh, do you see these guys with a new website? Hey, Jimmy, you know HTML, go set up a website. And what they failed to understand, is that Amazon wasn't about being a website. HTML doesn't fix it. It's a company that's built on entire different disciplines, different culture, different technology. IT isn't a cost center, it's the core of the entire business. And that thing starts spinning, and when it spins fast, it throws out outcomes that mean that 30 years later, Amazon is even more different than it was back then. And rather than closing the gap has just grown and they've diverged. And I think something similar is going to happen in the insurance space in the decades to come.
Well, look, we clearly at Battery agree with you. We continue to scour the world for the next generation of opportunities. We're super thankful for the two of you being here today, taking your time, giving your perspective to the audience. And I'm sure there's a few early stage InsurTechs in the audience that will walk away with a lot of great insights.